A few other little bits there. I highlight the bottom one really. I put there no change to pension relief and CGT main residence relief. Why have I put that? Why have I put no change to pension relief when I've just told you the whole world of pensions is in turmoil? Why have I said that? Crazy thing to say. The reason I said it is that in the coalition government's document, they said that they were going to embrace Lib Dem theories on tax avoidance. What are Lib Dem theories on tax avoidance? Well, there are two things that they have specifically said. Two things that they have specifically said. Vince Cable used to say this all the time when he was interviewed on the Today programme and said, we will pay for this, that and the other by doing away with tax avoidance. And John Humphreys would say, well, that's all very well, boyo, but how are you going to do it? What exactly is it you're going to do? And Vince Cable's reply always was, we will restrict pension relief for everybody to the basic rate of tax. It is an outrage, he said, that 40% taxpayers get 40% pension relief, when 20% taxpayers only get 20% pension relief. And I thought, well, that's because they're 40% taxpayers. But anyway, put that to one side. When they introduced the new rules on the 22nd of April 2009, which were for people earning more than £150,000, there were a lot of commentators saying, thank God for that, it's not as bad as we thought. Because if you're earning 60 grand, 70 grand, you can still make your pension contributions and still get your 40% tax relief. That is not Lib Dem policy. At the moment, they haven't changed it, but watch this space, because if they are going to embrace the Lib Dems' theories about tax avoidance, that is number one on their list. What's number two on their list? Great irony here. Number two on their list is abuse of main residence relief. And after you've had our tea, I will be telling you how to abuse main residence relief. But before we get there, let's just savour the thought that the thing Lib Dems say is dreadful tax avoidance is dipping in and out of residences. Flipping is the new term, isn't it? Flipping residences. Of course, what the bloody politicians do, flipping their residences, left, right and centre, aren't they? And who was the most recent offender? That nice Mr. Laws, who was the Chief Secretary to the Treasury before he was also found to have fiddled his expenses and got booted out. But that was his claim to fame as well. He'd flipped his main residence. So watch that space. Few things there, not worth talking about. So let's get to some planning points. I'll give you some planning points before we wind up at 3:30. We've got 10 minutes. Now, the first thing you will say, that's not a planning point. That's just stating the obvious. But yes, it is stating the obvious, but it does lead into some interesting concepts, doesn't it? So, for instance, if you have an unincorporated business, whether it's a trade or an investment business, what's the effect of that? Well, you pay income tax at your highest marginal rate on whatever income arises. End of story. That is it. That is it. I have a client, very wealthy, with a portfolio of properties from which he does not need the rent, and he does not want to pay 50% income tax on that rent. And when he gets the rent, what does he do? He sort of saves it up and invests it in more properties. What is the point of him having those properties in his own name and paying 50% income tax when he could transfer them into a company? And I'll touch on this after tea, how you might do that, the sort of reliefs, what reliefs you might look for doing that. But just conceptually, you could transfer them to a company. You will get a capital gains tax uplift in the company level, which I'll explain after tea. But the fundamental thing is the income arising will be taxed at 21%, 20% from next year. There's a headline tax saving of 30% on the income. That's what he's worried about. It's easy. Supposing you've got, I don't know, a profitable sole trader. I was going to say fishmonger, but it's just a sole trader who is earning profits which perhaps he can't draw because those profits are tied up in stock and debtors and work in progress, all the usual things, but he is being taxed on the underlying profits. If he can't draw the profits, it might make more sense, might it not, to incorporate that business and to have your undrawn profits taxed at corporation tax rates, 20%, rather than at income tax rates, 50%. These are big differences. These are big differences. If I skip to the final bullet point on that slide, supposing you don't want to, what I call the whole hog, do a whole hog incorporation. Supposing you have got a structure, Barnes Rope LLP springs to mind, where you have a professional LLP, tax transparent, so whatever the profits are, the partners are taxed on it, whether they draw it or not. But turning it into a company wouldn't be all that attractive because the profits are too high. You've got too many people sharing in the profits. You'd end up with a company which would be large for corporation tax purposes. It would be paying corporation tax at 28%, albeit coming down. It would be having to pay corporation tax under the instalment regime because it would be large. And the members would have to agonise how they draw out the profits. They'd have to strip dividends, which might not be attractive. So there are all sorts of issues there, which is really why LLPs were invented, to give professional partnerships a limited liability status whilst giving them tax transparency still. But we don't like the 50% rate of tax. So why don't we introduce a corporate partner? Supposing we say, we've got a great idea, all these employees we've got, instead of employing them at the LLP level, what we'll do is we'll create a service company. We'll transfer the employees to that company. That company will be a member of the LLP. It is a member of the LLP, most important concept. It will get a profit share. Now, what's the effect of that? Well, the effect of that is that to the extent that it gets a profit share, that profit share is taxed at corporation tax rates, which might be as low as 21%, 20%. Who's saving? The other human being members are saving, aren't they? Their profit shares are going down, which are being then taken out of the 50% rate of tax. And the beneficiary is the company, which is paying tax at, let's say, 21%, just to illustrate the point. Now, what happens next? This is where you've got to think through. What happens next is the members, the individual members, just continue to draw from the LLP in the same way they have. They don't pay tax on their drawings. They pay tax on their underlying profit share. They do not pay tax on their drawings. So it doesn't matter what they draw. It's tax-free. It's the profit share that's taxed. So they can gradually draw down capital out of their business and replace it with capital that belongs to the corporate member. You are replacing human beings' capital, which is tax paid at human beings' rate, with companies' capital, which is tax paid at companies' rates. The individuals still get their money out. Now, supposing all the individuals draw out all their capital. So you now have a balance sheet with the assets of the firm represented by the capital account of the company and none of it by the individuals. What happens next? Well, supposing the individuals keep drawing. Supposing they overdraw their capital accounts, but the company is in credit more and more and more and more. Can the revenue stop you doing that? I don't think they can. More to the point, I have a QC's opinion that says they can't. So you have this rather interesting situation, don't you, that you will get more and more of the capital out by drawing down on your capital account, but you're not being taxed on your drawing down. You're being taxed on your underlying partnership share. Most important point. And if your partnership share is kept low and the company's is correspondingly higher, you are managing your income tax liability in a very attractive way. So I commend that idea to you. The third point on my slide there, which I've sort of skipped over really, is in the coalition government's document, they talk about reforming IR35. What's IR35? IR35 is the rules about personal service companies. Nothing was said about that in the emergency budget, but the most commentators assume that it means that there might be some relaxation. If there is a relaxation, it will make it easier for people to operate via personal service companies.